The cement sector is an interesting one right here because of the boom in building and construction, not just in Kenya, but all over East Africa, where the firm also operates. We're now joined on the line by Surendra Bhatia, Managing Director, Deputy Managing Director of Athi River Mining. Many thanks for coming on the program. 24% jump in pre-tax profit for the first half of the year, sitting at about $9.4 million. But your sales declined almost 14.5% despite the increase in pre-tax profit. Just explain that for us.
Yes, I mean, in terms of the performance of the company at the first half, it's in line with the budget. We have had a good first quarter and a good second quarter. In terms of the company's performance, we are on budget, but probably when you analyze the quarter-wise, the demand in the second quarter normally is slightly less, and it picks up again in the third and the fourth quarter. So if you compare it quarter to quarter with last year, you will see that our performance is improved. If you compare it half year to half year, you will see that our performance is significantly higher than last year. We have had a 27% increase in our top line and a 25% increase in our bottom line, profit after tax.
All right. Overall, cash generated from operations is still very stable because of a very proper working capital management. How are you going to be treating that going forward?
If I can request you to repeat the question, I couldn't hear that very well. Sorry.
All right, I'll repeat that. I said overall the cash generated from your operations are still looking good because of your proper working capital management. How are you going to be treating that forward in terms of your projections for the second half of your financial year?
Well, our increase in the business has essentially come out of cement business. In cement business, the working capital is quite well managed in terms of the fact that we mine all our own raw materials. We control the entire value chain of manufacturing, and therefore, going forward, we expect that the working capital cycle would be improving. The more we sell cement, the more the turnover is driven by the cement business, the lesser impact it has on our working capital. So going forward, we expect that in the next 6 months, the working capital will be at the same level as it is today. It won't increase, and therefore it will be relatively easy for us to ensure that the working capital doesn't make it become a constraint for growing the business as we go forward.
This 1.1 billion shilling cement plant in Dar es Salaam that you're pegging a lot of your growth on, how important is it to the company's strategy going forward?
It's very important because with the commissioning of the Dar es Salaam plant, which is expected any day now, we would be doubling our capacity in absolute terms. In Kenya, we would be doing about 800,000 tons this year. 750,000 tons is the capacity in Dar es Salaam. So in terms of pure impact on the company, the top line should double. The bottom line should also see a similar growth pattern. In terms of the company's diversification strategy, this plant is also very important for us because we would be moving into a market which is in the EAC. We would be servicing the Tanzanian market, which is cement diffused from Tanzania. We would be closer to the customers. We already export some quantities from Kenya into Tanzania, but being in Tanzania will give us an easy access into the different markets of Tanzania, which is at the present moment cement deficit.